Maverick traders, welcome out to your market roundup for December 20th. Corey here with you. Make sure that you follow your trading plan and let's discuss the markets here. So, as has been the case in 2022, the markets are not going to let us go into the end of the year without some volatility. Overnight, there was big news out of the Bank of Japan. We'll make sense of that together. But in markets, I mean, it was a pretty quiet day. I'm pretty surprised by the market price action, how well it held in, and that's telling. There was some really quote unquote bad news, and yet the market held up really well. So Dow, S&P, Russell, all up about 0.5%. NASDAQ lagged a little bit, flat on the day. Oil and gold up. And as we look at the advancers versus decliners, about 6 out of 10 stocks going up. So a little bit more bullish day overall. The 50-day moving average is kind of flipped, where more stocks are now trading below it than above it, which was not the case, again, coming into this past week. This past week, we've really seen the markets fall. We were going on 4 or 5 days in a row of market downturns. And so as we look at the daily news, today's price action snapped that 4-day losing streak. And it was kind of a free fall. We had really sold off from that downtrend line. Overnight, though, the Bank of Japan tweaked their yield curve approach. And so basically, they're trying to control yields, and they've been pushing on the market to keep yields down. While the rest of the world has raised rates and allowed their markets to trade freely, the Bank of Japan has kept a zero interest rate policy and had curve controls. Basically, they're trying to tweak the yield curve to keep that low end low, or that 10-year yield low, and down closer to zero. And it's become quite a chore, and markets are kind of disconnected. And so they relented and they said, okay, we're going to let it trade within 50 basis points of zero above or below. And immediately the markets reacted. The yen spiked higher, 4% higher. And this has been an ongoing issue. I've been talking about this in our FX midweek. I do the FX midweek, just as Joe does the trading room stock and option midweek. And I've been touching on this point that the Bank of Japan is in kind of this precarious spot. And usually when central banks are trying to kind of control price, it doesn't always end up very well, and you get these disconnects. And so it was very dangerous to be short the yen. And sure enough, a 4% move is massive. Understand that with currencies, the volatility overall is lower, and that's why you trade in pips. That gives a little more bang for your buck. But you know, the US dollar Japanese yen pair might have 10% volatility for the year. So a 4% one-day move is like 40% of an annualized volatility. To put that into perspective, if stocks have, let's say, a 25% expected range in terms of volatility, that would be like them moving close to 10% on the day. I mean, it's just a really big kind of historic move. And yet the equity markets shook it off. Japanese equities traded higher. That's really, really good price action, and something that could have been tumultuous. So as we look at the price action, obviously we failed at the uptrend line. We talked about this over and over again. You know, my viewpoint has been that we would trade more neutral, that ultimately, you know, I was calling the market's bluff up here, and I'm somewhat going to call the market's bluff down here as well. I personally think we're still in a neutral market. These moving averages all kind of bunched together, going sideways. That's usually when you start to ignore moving averages. So I get it. If your inputs are moving averages and that's kind of your sole focus, if you're more bearish than anything else, I get it. I understand it. And I've been bearish myself, but today kind of changed, and it's not just that. I mean, we filled this downside gap. This gap was an area, an unfilled gap like this in the S&P 500 is not all that common. And usually there will be a filling of the gap, which has happened this week. That's technically important. This trend line, to me, you know, I've been pondering about what are we going to do in the first quarter? How are markets going to behave? At Maverick, we've been planning out our year-end review, full year forecast, which we're going to do in January. And you know that my thesis has been, well, ultimately I thought we would trade up to this area and then fail and probably head back towards these lows. But I've been rethinking that. And it's not just the filling of the gap. It's not just the nice price action today, holding in and staying positive in really bad news. There's more to it than that. If I look at investor sentiment, it's been down in the dumps. In fact, equity put to call ratios, the amount of people buying puts is like at 2008 levels, which in 2008, November of 2008, the last time it kind of spiked to these areas, the market was in a very different place and we were crashing and they were just rushing after it. And so what does that tell you? Well, it's sort of counterintuitive, but essentially, if institutions are buying a lot of puts, then they're hedged, they're protected, and the probability of a big drop becomes lower because as your stocks fall, your puts go up, and they're able to sit through that. And so the more they load up on those puts, the less likely the big downward slide becomes. That's just one aspect of it. If I think about sentiment, most people expect a first quarter drop for price action to be ugly because the economy's weakening. But then I started thinking about, this is old news. They've been reducing earnings expectations all year long. It's been priced in. It's a big part of why we've been declining. The market expects that the Fed interest rates have lag, and so and so I'm starting to think, well, that's probably priced in. And as I really think about what happens next and where the pain trade is, I think the pain trade is a push above this downtrend line. Wouldn't that set the markets into a frenzy and be confusing? Everyone loading up on puts and expecting that next shoe to drop. What are they going to do if we spend the first bit of this year up above that trend line? So these are, right now it's kind of a thesis. It's kind of a process of building a thesis, and I haven't acted upon it aggressively. But today, for the first time, really, I've moved to a more of a bullish stance. I really haven't faded this downturn and tried to buy. I admit I did it today. I added some bulls. I evened up somewhat on my posturing, and I think I'll add more bulls as we kind of progress this way. Now, that assumes we do. What if we don't? What if we just kind of break down here and it just can't muster much of a bounce and so forth? Well, I get some expectations wrong, make no mistake, but I kind of look at this and it's not as much technical as it is based on market sentiment and so on, because for me, I talk about the four stages of a trend and everybody's inputs and expectations and how they grade the markets are different. And I certainly pay attention to the moving averages, but I always emphasize that moving averages are important in a trending environment and less important in a non-trending environment, which is what we've been in. So I've been somewhat ignoring those moving averages and saying they're not overly helpful. Well, we could be rolling over just like we did here. See this bow tie pattern? You crossed up, you crossed right back down, you crossed up, you crossed right back down. Okay, after a correction, it's not uncommon. After a correction, not uncommon. After a correction, maybe that's exactly what occurs. Sometimes when there's more of a reversal, you don't get the bow tie, you get the consolidation and kind of this kiss that just the moving averages converge, but then ultimately follow. And I think we've been flushed out enough to the downside that it's due. Now, if we think about whether you use Elliott waves or four stages of a trend, I kind of look at both approaches and I say, okay, what stage do I feel like we were in? Well, this was the big downside exhaustion. And then this was kind of the upside exhaustion of that. So that was a completion and kind of an ABC correction, right? A 1, 2, 3 type of approach here. And sure enough, we've fallen off of that as I anticipated. But is it now going to resume to the downside? So if I look at this big picture, I'm like, okay, here's the first wave down, and then you get the correction. Here's the next wave down, and then you get the correction. Here's the next wave down, and then you get the correction, but ultimately, usually there's more of an A, B, C, kind of a big, huge correction following five huge waves. Where does the ABC take you? Usually back to the fourth wave. So that's one aspect of it. If you use Elliott wave, you'd say, well, we've had a pretty good five-wave downside move. And I look at it as here's where the race began, here's where the race ended, and we're currently in this big, choppy, ugly trading environment. I don't think this is a runaway bull or bear market. I think this just gets ugly for a while. And, I still think it's that market. I could be dead wrong, but I have to express what I feel, what I've experienced, what I've traded, and so on. And so ultimately, I think that this is what's happening. I think that move above that downtrend line, I mean, that would confuse and confound. I think there's a pretty good rally coming here. Not only, kind of end of year, but the first part of next year. That's not a popular opinion. That's somewhat of a shift, but it's more of where I'm now anticipating things to go. I will feel better about that thesis as we kind of establish a little bit of a change in short-term pivots. A little bounce for a couple of days, and then maybe we pull back for a day or two, and sure enough, they can't get it to drop any further, and then we start to, and I'll say, I am positioned well, I am positioned perfectly, this is what's playing out, and we're going right up to that target, and we're going to burst through it. We're going to knock through that, and it's going to set off a buying frenzy above that downtrend line because short sellers are going to have their stop losses up here. Anyone that's bearish, this is such an obvious place to trade against, and they know they're wrong above that level, and the market likes to inflict pain and likes to go towards, it's kind of do what makes you feel uncomfortable. This is a thesis that I try to live off of. Now, that doesn't mean always being a contrarian and doing the opposite of whatever the market's doing. In a lot of cases, it's hard to keep going with the flow. It was hard to keep buying and to stay bullish during this run. It was. I kind of took some off and said, hey, I think we're done. And then I realized, hey, we're going to push up there and temporarily trade above the 200. And I started changing and stayed bullish, waiting for an exhaustion signal and such. So sometimes it's hard to go with the flow. Sometimes it's hard to go against the flow. And man, do I think it's kind of hard to be a buyer here. There's just not a lot to hang your hat on. And the markets tend to kind of confuse and confound in many cases. So the QQQ, the NASDAQ 100, chart-wise, it looks like a big old ugly mess. I mean, those moving averages are sideways. You could say 20s above 50. That's bullish. Yeah, but, they're moving sideways. Just indecisive, right? And it looks more bearish than bullish because, my heck, we've just been plummeting for some time. But again, whether it's Elliott wave or what have you, I mean, this is just such a big exhaustion low that really was after a big five-wave pattern to the downside. The A, B, C correction should take us back to wave 4. I don't know that the NASDAQ has enough strength to get that high, but that's the way it really should kind of behave. And up to that level, if you get up into this area, people will be mind boggled that the market's going up, and they'll say, but the economy is slowed and we're in a recession and whatever, right? They will say, how is this possible? But my goodness, I think it's what's going to happen. So I can't change my brain. I'm trying to put as many factors in place as possible and really figure out where things are going to go. And today, I felt like I had to make some adjustments and get bullish at these levels. So time will tell. I mean, I'm kind of sticking my neck out there and going to look like an idiot here in a week or two if this isn't playing out. But that's ultimately how I see, and I've talked about some of those key points, how I see it behaving. Let's look at the heat map here. Tesla, it has been its own animal and it has been ugly. Now, what I love about this, another thing that makes me bullish is what? Tesla has been in an absolute free fall, and you usually get the biggest move as like an exclamation point at the end of the sentence. I am not rushing out to buy Tesla, but I do think Tesla, although it's not a huge market mover, it's not an Apple or something that really can move the markets by itself, and it's always kind of moved to the beat of its own drum. I do think it being completely washed out to the downside, huge volume today, massive deterioration in the price action with a huge expanded range bearish candle. It's indicative of what I think is happening here, which is basically the selling has been washed out. Energy starting to recover a bit today. The large cap tech names, Apple flat, but Google, Amazon, Microsoft, these have been weighing down the markets for some time, and they had a decently positive day. And everything else has held up really well. I use a proprietary system. I've taught my Bollinger Band system, right? Where you trade it with a trend, so you can only buy if you're above the 50, only short if you're below. If you get to the overbought or oversold within those bands, and there's some other criteria. Well, lo and behold, on my scanning, I've got a mountain of potential buy signals that are hitting their lower band and still above their 50 period MA. Oversold, but still in bull markets. I don't have a single stock popping up in the scan to short. So the market as a whole, and in fact, the Dow Jones Industrial Average, if you look at DIA, it's on a bullish Bollinger Band buy setup. So DIA, which is the Dow 30, used to be watched like we now watch the S&P 500, which is a better indication of the market as a whole. Again, technically, although the market is sold off, I'm getting a mountain of buy setups and not one short. And then when I go and look at things to short, everything that I want to short is washed out. I've talked for the past few weeks about shorting AMC and GameStop and all these names. I can't short them here. To me, this is an area to take profits. And I don't know, maybe the bounce will be tepid. Maybe it'll just, fade pretty quickly. Maybe we'll get things to short in the coming days. But it's hard for me to find anything I want to short after this decline. Everything that's popping up on some of my own scans are actually bullish, much, much more bullish than bearish. So we're below the 20. We're below the 50. The slope on the moving averages is sideways. But why do I think we bounce? Because I don't think those matter too much in this sideways environment. If this market is bad, the bounce will be tepid. It'll set a lower high and will come right back below this low. And assuming that happens, my thesis is somewhat broken in essence. It's not playing out. We're certainly not getting an end of the year rally and so on if that's happening. If I'm right, we won't do that. Basically, we'll bounce, we'll pull back a little, we'll bounce some more, and we'll just start heading in January towards that trend line, and sometime in January up through that trend line. So my bearish list, I can't put a lot of conviction behind. My bullish list, I mean, I had quite a few candidates that I think could be bought. Here's Caterpillar, and you have a few things happening with Cat. You have kind of a cup and handle. You have certainly consolidated for some weeks, and it's just so bullish. Look at how well it's held up in a market that's been all over the place. They cannot push this stock down. The declines continue to get bid up. I think we're headed up and out from here in Cat. As we look at Berkshire Hathaway, I mentioned this, that what I think is in play, and I was advocating towards buying the dips, because this is what we talked about, is that you're going to get pullbacks. But what I think is happening, see how it was lower highs, higher, or lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. And then we kind of bottomed out. And so these should start to zig and zag, similar to how these zigged and zagged, but in the opposite direction. And I really suspect that we're headed back towards those highs. This has been a stock that has vastly outperformed the markets for some time, and I suspect it should continue to do so. So it's right here, right now, is like picture-esque. In fact, it's a Bollinger Band buy setup. It's hitting the lower band, still holding above the 50. I think if we're creating this kind of rounding shape, this should be as low as it goes, and we work our way up through 320, then we get some sort of correction, and the zig and zag keeps going until we eventually get up there towards 360. Now, it's not going to get to 360 for a few months, but I think we're headed that way. Shopify. Talk about some stocks that have been left for the dead. Shopify has fallen on very hard times. And one of the things that I believe in, I talk about that there's really two thought processes when you're trading. You can have pullback type of strategies, or you can have breakout type of strategies, right? You can be in more buy the dip mode, or you can be in buy the breakout, buy the momentum. I pretty much eliminate all of these. Like Caterpillar's setup is more of a breakout setup, but Cat is up near its highs and it's just incredibly bullish. That's when I will take a breakout. I will not trade breakouts in things that have been down a lot, right? Because you have all this overhead supply, all these dead bodies, all these people that bought poorly at higher levels that want their money back. But what I will do, if I feel like I have the right setup, is buy the dip. And Shopify, this is high vol. This is, again, kind of a corrective phase, right back to the 50 MA. It's right at the levels where we should bounce. And it'll be choppy, but it should work its way back up towards 45. If we do some back of the envelope math here on this kind of price action and this pattern, if you look at that decline, see how 45 was an intermediate pivot? It was the peak on the correction, and then you dropped all the way down here to about 20, let's call it, it's 24, 23 something. I'm going to call it 23. From 45 to 23 is a 22-point cup. So the size of this entire cup was 22 points. The handle should usually be about 30% of the size of the cup. So about $6.60. $6.60 would be about 30% of that. So from 45 down 660 would put us at about 38.40. So we're a little below that, frankly. We're at 36. It's a little deeper than a 30%. Usually the handle's about 30%. This is probably 35%. So it's not picture-esque, but it kind of has that mode of, peaks and valleys. If we can hold here, we should work our way back up towards 45 and possibly through. Now, again, I wouldn't buy a breakout above 45 because you got all this overhead resistance. I don't buy breakouts on things that are down a lot like that. I buy breakouts in things like Caterpillar that are up near their highs. PayPal. This has been one that we've talked about for quite a few weeks now as a short candidate. I think we had it in last week here, but either way, ultimately, we're down to that level of support. I still think it's a candidate for continued shorting, but I would say it's a little long in the tooth. And I couldn't find anything where I was like pounding the table. I don't have anything popping up on my scans that's really set up well for bearish trading. Square we'll talk about. It's really kind of been in this type of consolidation, and this one you could short on a breakdown. I'm not sure it's going to happen here in the very near term. If the markets do rally, you should probably pull this up again. If you've been shorting AMC and GameStop and those names, I think it's a profit taking area more than kind of really punching the gas. And again, on the bearish side, Uber, it looks more bearish than bullish. It's not acting well. I could envision a scenario where this bounces and then continues to the downside. Certainly possible, but I'm just not high conviction on any of these potential bearish candidates. And, you know, everyone's systems and everyone's approaches are different, and I'm not trading this market right now according to really a big trending environment. If I felt that we were in an obvious runaway trend or something like that, you know, I would say we just have to go with the flow and short. And that might be exactly what this is. Maybe I'm overthinking it. Certainly possible. But if it's a choppy environment, it's really still set up to be a buy setup. Just as we talked about that if it's choppy, you want to fade the move. So as it rallied last week, you know, a week or so ago, up to the trend line, you'd want to short, right? Well, now we've had the opposite. We've plummeted. And if we're in a non-trending environment, what do you do down here? Even if we're not going to burst sharply higher, we're at the point where you'd fade the sell-off and be a buyer down here for the choppiness to continue. If we're just going to kind of gravitate around these levels, it's a buy. If I'm right that, you know, filling the gap and all those other factors we talked about, then ultimately we're still at a buy. So I was neutral on the markets. That was working. Now we've kind of pushed that to the downside, and certainly debatable as to whether or not the downside will continue. I do have to say that it's not blatantly obvious, let's put it that way, that you should be a buyer here. And everyone should follow their systems and their approaches. But I would, you know, certainly think about, well, what if this is a choppy sideways market? And what's that going to do for your positioning and your expectations and your portfolio and so forth? And kind of see if the markets start to work their way higher into end of year. Consumer confidence on Wednesday, earnings reports. We've got FedEx, we've got Nike, Micron, I believe, is on Thursday. So a few reports coming in. Full disclosure, I actually have a bullish position on in FedEx into this Friday. So we'll see if we get a little pop there. That'd be good for me. If it sells off, well, I'll end up with a loser on that one. So we'll leave it there. Kind of different than probably what you expected out of the market roundup today, but that's the way I see it. So that's the way I'm going to express it. Thanks again, everyone, for being here. Happy holidays. Have a great Merry Christmas, and we'll see you next time. Goodbye.